This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 9, 2026, and this is the New York pre-market. Now, let's get into it. We are opening the books on Thursday, July 9th, and the market is already displaying a fractured personality. The S&P 500 is down 0.3, but look closer. The Dow is shedding a full percent, the Russell 2000 is underperforming, and the VIX is sitting at a sedate 16.13. We aren't seeing panic. We are seeing a surgical rotation out of rate-sensitive cyclicals and into AI infrastructure. Let's see if this divergence is a warning shot or just noise. Turning to the calendar, the macro data room is quiet. There are no major economic releases scheduled for today or tomorrow. The focus is squarely on earnings reactions and sector flows. PepsiCo, Delta Airlines, and CAG Corporation are reporting today, but given the broader macro backdrop of a flat yield curve and sticky 4.17% CPI, the market isn't looking for a new narrative. It's pruning the old ones. Apex. What's the immediate risk here?
The risk is that with no macro catalysts to drive direction, the market is forced to trade purely on relative strength. We're seeing a clear bifurcation. Capital is abandoning financials and materials to chase AI hardware and energy. The risk isn't a broad crash. It's a deepening hole in the mid-caps and industrials as liquidity pools exclusively in the hard assets of the AI stack.
Let's break down that fracture. The S&P 500 SPY is at 745.4, down 0.31%, while the Nasdaq QQQ is green at 711.44. Meanwhile, the Financial Select Sector SPDR Fund, the financial sector, is off 1.93%, and the materials sector, is down 2.62%. Pulse. How does the market feel about this split? It feels comfortable, which is precisely why it's dangerous. The VIX is anchored at 16.13, well within its 5-day range of 15.53 to 17.3. That low volatility print tells me the crowd isn't bracing for a systemic event. They are treating this sector rotation as a normal rebalancing act. But look at the breadth. The financial sector and the materials sector are getting hammered, yet the broad index doesn't care. That disconnect means retail investors are likely chasing the winners, tech and energy, while ignoring the rot in the banks and materials. It's a complacent vibe heading into a potential support test. So, complacency meets technical stress. Grid, let's talk mechanics. SPY is at 745.4, sitting just $6 above its 5-day low of 739.51. What does the chart say about that floor?
The structure is fragile. SPY is currently trading in the lower quartile of its 10-day range, which spans from a low of 716.58 to a high of 752.41. The immediate concern isn't just the 739.51 level itself, it's the volume profile around it. We are seeing QQQ hold above 700.91 while SPY drifts lower. This tells me that the S&P 500 support is artificial. It's being propped up almost entirely by the megacap tech component. If QQQ starts to waver, SPY has no broad-based buyers to catch it. The 739.51 mark is the line in the sand, and right now the defense is thin.
And that thin defense is exactly why the VIX stays suppressed. As long as the tech giants hold, the index looks fine. But internally, the engine is stalled. You have the financial sector down nearly 2% and the materials sector down over 2.5%. The calm in the VIX is a lagging indicator. It hasn't registered that the economic engine, the part of the market tied to actual industrial activity and lending, is failing to perform.
That's a fair point on the internal weakness, but don't confuse sector weakness with index breakdown. I'm watching the IWM Russell 2000 at 293.48, which is also testing its 5-day low of 290.68. Small caps are rolling over, yes, but SPY hasn't broken its immediate support structure yet, until we see a high volume close below 739.51. My baseline is consolidation, not collapse. The 752.41 resistance is capping any upside rally anyway, so we might just chop here until one side gives way.
You're both missing the forest for the trees, or rather, You're focused on the branches while the roots are rotting. Grid, you're watching SPY support, but SPY is weighted toward the very tech names that are now disconnected from reality. And Pulse, you're calling it complacent, but I call it mispriced. The 10-year minus 2-year yield spread is flat at plus 0.35 percentage points. Historically, a flat curve precedes recessionary pressure. Combine that with CPI at 4.17% and core PCE at 3.41%. Both comfortably above the Fed's 2% target, and you have a recipe for a repricing event that the VIX simply refuses to reflect. The VIX is at 16.13 because participants think the Fed will save us. But with GDP slowing to 2.9% and unemployment at 4.2%, the soft landing narrative is cracking. The financial sector knows it.
Actually, SPECTER, I'd push back on the idea that this is a broad systemic failure. The data shows capital is actively selecting for quality within the chaos. Look at MU. It's up 6.5% to 1010.56. Why? Because it's tied to AI infrastructure investment news. Applied Materials, AMAT, is up 8.5% to 619.3 on analyst calls involving NVIDIA and AMD. This isn't blind speculation. It's a fundamental pivot toward hardware that generates cash flow and capacity. Meanwhile, IBM is dropping 5% on multi-agent AI upgrades. The market is rejecting software narratives and rewarding physical infrastructure. That's not a bubble, that's a rational allocation of capital in a high-rate environment.
So, CIPHER, you're seeing conviction in the AI hardware supply chain. Is that enough to offset the weakness in the financial sector and the materials sector?
It's sufficient to create a two-tier market. The AI infrastructure trade is the only fundamental anchor right now. MU and AMAT are rising because they are beneficiaries of a multi-year capex cycle that is immune to short-term rate fluctuations. Investors are willing to pay a premium for that certainty. Conversely, they are dumping the financial sector because the flat yield curve squeezes net interest margins. It's a binary choice: bet on the future of computing or bet on legacy banking models. Right now, the money is voting for compute.
But CIPHER, you're ignoring the denominator. Those valuations assume growth continues uninterrupted. With the yield curve flat and inflation sticky, the cost of capital is staying high. You can't grow your way out of a recessionary squeeze forever. The reason the financial sector is down 1.93% and the industrial sector, industrials, is down 1.7% isn't just about margins. It's about the anticipation of reduced corporate borrowing. The market is front-running the slowdown. The AI trade is loud, but it's narrow. Once those hardware makers report, if the guidance doesn't justify the multiple, the floor drops out.
Let's zoom in on the leaders. MU is at 1010.56, up 6.5%. Applied Materials, AMAT, is at 619.3, up 8.5%. Grid, what are the technical setups here?
Both are in strong uptrends, but AMAT is showing more immediate momentum. It's pushing towards the upper bounds of its recent consolidation. MU is gapping up, which usually indicates strong overnight institutional ordering. However, when you have a gap up this size, you often get a retest of the pre-gap level. Watch for volume contraction on any pullback. If MU holds above its recent consolidation zone, the trend remains intact. AMAT, meanwhile, is breaking through resistance with force. The key here is relative strength. Both are decoupling from the SPY drag, which suggests their technicals are driven by specific catalysts, not general market beta.
And that decoupling is what's fueling the sentiment anomaly. Retail traders are seeing MU and AMAT green while the rest of the world bleeds red, so they rotate in. It's hurting behavior. They see green and ignore the red in the broader indices. That's why the VIX stays low. The biggest names are holding up the spirit of the market, even if the fundamentals elsewhere are shaky. Now, let's look at the other side of the coin. The laggards. The financial sector is down 1.93%, the industrial sector is down 1.7%. CIPHER, why are these names getting sold off specifically now?
It's the yield curve. A flat 10-year, 2-year spread puts immense pressure on bank profitability. Banks borrow short and lend long. When the curve flattens, that spread compresses. Combine that with the regulatory burden on digital assets, which is hitting fintech and some traditional lenders, and you have a fundamental headwind. Institutions are reducing exposure to balance sheet-sensitive names. They aren't exiting the market. They are exiting the interest rate-sensitive parts of the market. They are moving into the energy sector, energy, which is up 1.76%, and the technology sector, technology, which is up 1.24%. It's a classic flight to quality and defensives.
And that brings us back to the risk. If institutions are fleeing financials and industrials, who is left to buy SPY when the tech names pause? The answer is nobody. That's the trap. The VIX is at 16.13 because everyone is waiting for the next big mover, and right now, that's only MU and AMAT. But when those names consolidate, or if the CPI data comes in hotter next month, there will be no bid left in the broader index. The flat yield curve is the gun on the mantelpiece. It's loaded. And when it fires, it won't just hit the financial sector. It'll hit every name that relies on cheap debt to survive.
Let's check the broader sector ETFs to confirm this rotation. The energy sector, energy, is up 1.76%. The technology sector, technology, is up 1.24%. On the flip side, consumer discretionary, is down 1.78%, and the materials sector, materials, is down 2.62%. Grid, does the underperformance in consumer discretionary and materials validate the recessionary fears?
It validates the weakness, but not necessarily the timing. The materials sector at 50.16 is testing key support levels. When materials fall, it usually means industrial orders are drying up. Consumer discretionary at 115.3 is also softening. Technically, these are secondary indicators. The primary driver is still the SPY/triple Q split, as long as triple Q holds 700.91. The consumer and industrial weakness is treated as noise, but look at the IWM at 293.48. The Russell 2000 is essentially confirming the materials sector and consumer discretionary weakness. Small caps are the canary in the coal mine, and they are flashing red. If IWM breaks its 290.68 low, it confirms that the soft landing is becoming a no-landing scenario for the average company.
Exactly. And that's where the sentiment turns ugly fast. Small caps are highly sensitive to credit conditions. If the financial sector is down 2%, small caps get squeezed harder because they rely on bank loans. So you have a feedback loop. Bad news hits the financial sector, small caps drop, sentiment sours, but VIX stays low because the mega caps are still green. It's a delayed reaction. The crowd thinks they have time to exit the small caps, but liquidity dries up instantly when the tide turns. SPECTER, you've been challenging the consensus on the VIX. Give us the bottom line. Why should we worry about 16.13?
Because volatility is a mean-reverting asset, and it's currently depressed. The 16.13 reading is within a tight range of 15.53 to 17.3. When you combine that suppressed volatility with a flat yield curve, plus 0.35 pp, and sticky inflation, 4.17% CPI, you are setting up for a violent repricing event. The market is pricing in business as usual, but the macro data suggests structural stress. The drop in the financial sector and the industrial sector isn't a glitch. It's the market correctly identifying that the current growth model is unsustainable at these rates. The VIX doesn't know it yet, but it will. And when it wakes up, the lack of depth in the broader market, because everyone is hiding in tech and energy, will cause a sharper drawdown than anyone expects.
Apex tie this together. We have strong AI hardware, weak financials, flat yields, and a low VIX. How do we navigate this?
You trade the split. Do not try to predict whether SPY will break 739.51 or hold. Instead, acknowledge that the market is bifurcating. On one side, you have the old economy, financials, the financial sector, materials, the materials sector, consumer discretionary, and industrial, the industrial sector. These are under pressure from the flat yield curve and sticky inflation. On the other side, you have the new economy and defensives, AI infrastructure, MU AMAT, energy, the energy sector, and select technology, the technology sector. The strategy is simple: align with the capital flows. Rotate out of the rate-sensitive cyclicals and into the sectors with independent growth drivers or defensive characteristics. Monitor the IWM and the materials sector closely. If they accelerate their decline, it confirms the rotation is deepening. But do not short SPY blindly. The tech weighting provides a buffer that makes broad shorts risky until the VIX actually responds to the macro reality.
Let's recap the key data points. SPY is at 745.4, testing 739.51 support. Triple Q is at 711.44, holding 700.91. The financial sector is down 1.93%, while the technology sector is up 1.24%. Micron is up 6.5% to 1,010.56. The VIX is 16.13. Disclaimer: this is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.